All right, how's it going? And welcome back to How to Invest in Commercial Real Estate. And we have an awesome show, mainly because I think it's super relevant. Super relevant.
Tell us about it, Braden.
Yeah, well, I mean, anything we need to open up the show on? You're doing an awesome development at Bixby. Tell us something new.
Well, we just got done meeting on that project. We are, unless they lied to me, we're on budget and on schedule.
That's nice. Definitely a lie.
And we're getting ready to bring the piers out of the ground and pour the foundation. So
very nice.
Yeah.
All right.
Lumber prices are coming down. Hopefully other things start coming down as the economy slows, and that'll help us build it for a little bit cheaper.
Be nice.
Then we hope we fill it.
That'd be different than what we did.
Yeah, I wanted to show you a graph because I looked it up in our meeting of what lumber prices have done over the last few years. And, you know, we made the decision to go to steel on the Criterion building because lumber was so high, and it's done nothing but fall like a rock since we decided to go with expensive steel.
That makes me feel great.
Yeah, I just want to let you know that.
That was Braden's decision to
I didn't know they could. Could they pour foundations on sand? Is that
yeah, we piered. We piered all that.
Piered. Yeah. Okay. Interesting.
Anyway, so one of the biggest drivers for buying commercial real estate is the leverage that you can get on it. And you don't want to use all of your own money if you can help it. And so today we thought we'd mention or discuss 9 ways to go about financing your commercial real estate deal.
Pulling up my notes, but
yeah, we've talked about how leverage is the name of the game to maximize your returns, right? But I don't know that we've ever talked about all the different ways. We've talked about them maybe at one time or another, but not all in the same show.
Yeah, so I think I'd like to start off with some sort of analogy, right? Joel's talked about the money machine analogy, money machine analogy before, but it's basically this idea that if you could go buy a machine that made $100,000 a month and it only costs you $50,000 a month, the only question you would ask is how many can I buy? Right. And that's essentially what we're doing here. We're talking about the spread between the cost of capital and what your investment is actually making. So in a real estate investment, you know, you may evaluate that on a cap rate. That's super common. So an 8 cap deal that year, assuming no income growth, is going to make you 8% return on your equity, assuming you bought it in cash. But if you can go borrow the majority of the funds from a bank or some sort of other institution at half of that, let's say 4%, property's making 8, you borrow the majority of the money and they only want 4. Now the lower money you put in, right? If the bank's taking 80% of the deal, you're only putting 20% in and you're making your 8%, right? Because the property made 8% unleveraged. So you're making the 8% on your 20% down, but you're also making the 4% on everything the lender is putting down. So really, you're making almost 12, right? And that's the idea that we're talking about today is how to maximize and generate positive leverage.
Right. Yeah. And so the first one is the most simple that we'll go over, and it's local regional banks. And we like to use local and regional banks. A lot of people don't, but the banks are easy to work with. And they'll leverage up to 75 to even 85% on a deal, which is great. The positives are you know them. If you have a problem, you can go to them. They don't want your property. They're less likely to take it back. They'll want to work with you before they foreclose. So all of those things are positive. The rates are generally low. They may not be the lowest on the list that we have today, but they're generally pretty low. The negatives for a bank is that you have to sign personal guarantees. Yep. And so you're putting the rest of your assets on the line. And so if the deal doesn't work, let's say you just catastrophic, you have to hand the keys back. If they sell that property for less than what you have owed, the difference they're going to come after you for in the form of a judgment, and that'll hang over you for a long time until you pay it. So, but we've been successful in utilizing banks, especially when buying multi-tenant retail.
Do you think private bank or banks are the most common way? I mean, that's what we do. We seem to have it down. We know a lot of banks that we can go to, so it seems fairly easy to us. And everything else that you talked about, you think that's the most common way that people are buying real estate?
Statistically, yes. Yeah. That's the most common way. Like, I forget the statistic, but it's like 2/3 or something is lent out by local and regional banks in the United States. That's like two-thirds of the lending in the economy. I think it may be more. And
if I had to guess why that is, my thought would be this, that there's banks in every single local market.
Yeah.
Especially the smaller local markets. If you think about a small town near you, Okmulgee or McAllister. I'm talking about towns around Tulsa, but everyone has them. Big institutional lenders aren't necessarily going to be favorable on lending in those markets, but local bank will always lend in their local market. Yeah. That's number one. Number two is that most borrowers are not sophisticated enough to know what all the options are available to them. That's correct. Like when I started, I had no idea of some of the sophistication of the lenders on this list. Lastly is I think that a lot of commercial deals are not big deals. And, if it's a $500,000 here, there's no credit to the deal. It's a warehouse over here. Those are always going to be local banks because the other people on this list aren't interested in things without credit, or if they're below a certain size, you're not going to get them interested in lending on your deal. So those are kind of three reasons why banks are probably the most common.
Yeah, we found a property in Louisiana, and the first question we asked is, what's the debt look like? We found a local bank who's got a branch a few miles away from the property we went and bought in Louisiana, and they were ecstatic to give us a loan on a retail asset they drive by every single day. So, it's as easy as Googling banks, right, in that local market. The next thing I would say is, and I know we're not rating them, but would this be probably the cheapest, easiest, generally most favorable terms on the real estate we buy? Would you say that's probably from banks? Out of the 9, it's cheapest, friendliest, easiest?
It's going to be close to the cheapest. Okay, not necessarily the cheapest because government-backed loans tend to be the cheapest.
Sure, but the doc prep fees and the hassle and the time and the legal,
for sure, the cost of closing the loan, the hassle of closing the loan, this is going to be on the low end of that for sure.
Yeah.
That might take us to our number 2 way if you guys are done with that.
Yeah.
And that's HUD, right? And I don't have any experience with that. I know you've been working on a HUD loan for 2 years or?
We know.
No, we did. We kind of gave up on it because interest rates spiked and the cost spiked, and we got debt constrained on our leverage. So we ended up bailing on the HUD loan. But I have had a HUD loan before. It's housing and urban development, and they have specific programs, especially they have lots of different programs that I'm not educated in to discuss, but they do loan on multifamily. And they are very strict.
And they're multifamily and only multifamily or at least related?
Well, the program I'm thinking of is only multifamily.
Okay.
I'm not aware of any HUD programs for loans for retail.
Okay.
But they do have farming and agriculture and other things that they loan on.
Gotcha.
So HUD, there's a couple of positives. First is they're very low rates compared to maybe the lowest. The second is that you can typically get higher leverage. Not always, but 90% on a multifamily development or a multifamily deal is possible. And I'm not sure of any other lender that can do that. On like a development project, you can get a 40-year fixed, 40-year AM. Oh. So we were late to the game. If we would have got that HUD loan started and done while the rates were 2.8, can you imagine having a 2.8% fixed rate for 40 years? You're virtually guaranteed cash flow for decades. And so they're the longest AM, they're the longest fixed period. It does come with a lot of upfront fees.
Yeah, what's the downside? It sounds great.
There are downsides. I'm not going to get them all right. We're going to stay pretty high level here. But the downside is there's prepay penalty. It can be assumed. A lot of people don't like to assume HUD deals. They have relaxed this, but in general, in years past, you could only take funds out of the investment like twice a year. And they had to be approved through an auditing process from HUD. So HUD's going to audit it and make sure that you have enough reserves and that you're keeping the property pristine. And then only then will they allow you to take money.
Is it easy to go get one of these loans? You just call HUD up and say, "Hey, HUD."
No, it's quite difficult because all the government bureaucracy boxes have to be checked.
So this is one we definitely want to find a mortgage broker expert.
Yes, you're going to want to find someone that in your market that facilitates HUD borrowing, that knows people at HUD that can push this through, because it can take a year or two to get it all the way through.
So not the first time guy.
No, it's a forward looking. We're planning on developing this a year from now. Let's start the HUD process today.
So this is someone you pay to help you through the process.
They will take a fee, just like a mortgage broker will take a fee. Yeah. But then there's also just a lot of other fees and expenses. So this is a very expensive upfront process. And so some of that you can build into that high LTV, but still will add cost to your deal. So the amortization and the rate have to make up for that.
So real quick, who's backing the loans and their amazing terms? So what's the incentive, I guess, for HUD to do this? What are they looking for? What areas? I mean, I think the idea is kind of affordable housing, right?
Yeah, I think they want
market rate.
There's a couple different products out there as far as affordable and but if you're just doing a market rate deal, they will want to do a complete study on the market, and they'll want to make sure that this area of town, given all the other units that are coming online, needs housing units. There's a demand for the units. So they're just doing all of that in the background to say, okay, this area is going to be deficient over the next 5 years of multifamily units. And so we're going to go ahead and lend here.
Yeah.
Now, guys, if you're an expert on HUD lending, you probably are going to butcher everything we said, but we're just trying to be high level for some of our investors. And so we can move on to the next one.
All right. Well, let's stay with apartments. Brian, take it away.
Fannie, Freddie.
Fannie and Freddie. Yep. So if you play in the apartment world, obviously you're super familiar with. In the value add multifamily game, it's typically going in with some sort of bank debt, completing your renovations, stabilizing it, and then your takeout is taking it to market to sell. But if you want to keep it, or if you just want to lock up good loan terms, you're taking it to Fannie Mae or Freddie Mac to get permanent financing. And just like HUD, when it comes to existing apartment units, probably some of the best long-term financing options you can get on multifamily.
Yeah, and you'll need to consult with a broker. I highly recommend you use a broker that does this for a living, because it's not an easy process. It's not as cumbersome as HUD.
Yeah.
But we really have had good luck with Fannie Freddie loans. We have a great mortgage broker. We've had them on the podcast before. But these loans, they're going to be amortized most likely for 30 years. They're most of the time fixed for 10 years, although they do have 7 and 5 year fixed deals. They're more expensive than a bank. Yep. with legal and things and inspections and reports, but they're not near as expensive as HUD. And
so maybe 60 to 90 days instead of, a year or two.
I would say 60 days, 60 to 90 is probably a good ballpark from start to finish.
That's reasonable.
Yeah.
And their rates would be, how would their rates compare to HUD?
I think most of the time they're going to be slightly higher. I don't know what they are today, but an example, we have a loan right now with Fannie that is, I think, 2.83 fixed for, it was a 10-year fixed deal that we put on a year or two ago when rates were really low. So that's a great product. Fixed for 10 years, amortized for 30 years. Sometimes you can get IO for a year or two. The LTV is really good. It's up to 80%. They've backed off of that some lately, but typically 75 is not too hard to do in a decent market. It's a great option. Now, if you've never done a HUD deal and this is your first multifamily property,
Fannie Freddie.
Oh, sorry. If you've never done a Fannie Freddie deal and this is your first property, it's going to be tough.
A little bit of heartache from Fannie Freddie. They want repeat.
They like repeat borrowers, and they also like to see a net worth in excess of the loan amount. So if you're going to get a $4 million loan amount, you have to show a net worth of $4 million. That's not easy to do.
Full background check, full kind of. Not audit, but they're digging into who you are as a company.
Have you ever been late on payments? Have you ever been foreclosed on? Have you ever had a judgment against you in a lawsuit? I mean, they're going to get into it because same thing. If you default, they only get the asset, and so they want to know what kind of person they're going into business with.
So non-recourse,
not fully non-recourse.
Yep. Okay. And like your comment on HUD, right? This is a lender that's very involved and sophisticated in running this asset. They require financial reporting. They require reserves in interest and in taxes and in capital expenditure reserves. They'll require an inspection every so often. They'll require repairs be made based on the findings of that inspection, and they'll make you do it, or else you can't withdraw the money out of your escrow account. So you're dealing with a sophisticated lender who doesn't have any recourse except the property. So they're making sure that property is accurately being taken care of and reserves are being built up and repairs are being made.
Yeah, I think they're kind of quasi in between a HUD and a bank in that they don't force you to do an audit like HUD does, and they don't restrict you from using the money. Where they want to see is your tax returns, monthly and yearly P&Ls. And they're going to withhold reserves of several $100,000, let's say, on a property, and every month or every year they'll take additional reserves, and then at the end of the year they may give you a list of things they want you to repair. So that's kind of
real quick. If they want to see that, back to number one, real quick. Private bank, a local bank. What do they want to see in terms of reports?
Good question. They want to see your tax returns.
Yeah, they'll email you every quarter, and that's it.
And you may get your local banker that you have a relationship with. They may email you and say, "Hey, how's the property doing?"
Yeah,
that's local bank. HUD has a full blown a third party company doing an audit on every dollar that you took in and you spent.
Okay.
So
all right,
let's keep going.
Yep.
Okay.
CMBS is the next one.
No, you done messed up.
I did.
Yeah,
I skipped
you did.
one.
Life company.
Yeah.
So interestingly enough, I've never done a life company loan myself, but just think, we all know what life insurance is. Those companies take your premiums, and in order to produce returns or dividends, they invest it in commercial real estate and other investments. And so, like, I met with a lender yesterday, Protective Life Insurance Company out of Birmingham. And so they have their premium dollars, and they want to go invest those somewhere, and they want to get a safe, secure return. And so life companies, good things about life companies, and this kind of comes from my meeting, but I knew some of this before that. They will lock the rate at application.
Interesting.
They haven't even committed to do the loan, and they'll lock your rate. And that rate lock is good for at least 120 days.
Wow.
For free. CMBS, we're not there yet, so I'll leave that. The other ones, though, I don't think they lock the rate that soon. You have to wait, and you have to put a deposit down at rate lock once they commit to doing the loan. I think, like on a Fannie Freddie deal, you have to, maybe 2 points of the loan you've got to put up. So if they go lock the rate, you have to put up this cash. So if you bail after that, then you lose that $200,000 deposit, let's say. So life insurance company, free rate lock at application, no deposit necessary. Also non-recourse. Way easier to deal with than CMBS and in some instances HUD and Fannie Freddie. Typically, they want nicer commercial real estate, typically. So good markets,
Class A,
maybe Class B type assets. They're not going to be just throwing their money at older shopping centers or C-class apartments. That's not going to be life insurance's game. They do new development. One thing I thought was interesting, typically they're a 65% LTV deal, but they have a program where they'll participate in the profits, and they can loan all the way up to 100%.
That's insane.
And I've never done that, but it was very intriguing to me.
Yeah.
We need to send them our Starbucks Marine Creek deal.
Yeah. So we'll see if they have interest. And life insurance companies have complete flexibility. So they can do a 30-year fixed, 30-year AM. They can do 15-year fixed, 15-year AM, and many combinations in between.
It's just a private company giving a loan, essentially, at their own
And so,
terms.
like Fannie Freddie, they're pretty much 10-year Treasury type loans.
Well, those are strict guidelines. Same thing with banks. Like banks have to lend on a very certain guideline based on the fractional
regulations.
banking system. Yeah.
Another thing we didn't talk about with the first few is that there are prepay penalties on some of these loans. I think I mentioned it on HUD.
Well, most all of them, except your regional bank, has a massive prepayment penalty.
Yeah, the longer you fix these deals, the more expensive that prepay is. So if you get in a situation where you want to sell, it's going to cost you quite a bit of money. And I don't want to get into how to calculate that because it's a little bit messy.
Fannie Freddie, though, we didn't touch on, is fairly easy to assume. Again, if you're a repeat borrower of Fannie Freddie, it's way easier to assume. If it's your first one, you're trying to assume a Fannie Freddie loan, probably going to run into some challenges, but definitely not as difficult as HUD or maybe a CMBS loan.
Yeah.
And by prepayment, all you're saying is if you decide to pay off the loan or even a portion of the loan, maybe they're going to charge you some percentage or some fixed amount.
Yes.
Okay. Yeah. Whereas a local or regional bank, even if, which is a big if they have a prepayment penalty, it's on if you refinance it to the bank down the road and they just lose out on the interest. If you sell the asset, I've never seen a prepayment penalty on selling an asset from a local bank. And I've done a lot of bank deals.
And here's the power of that real quick on a local bank. You have a loan, it's at 5%, rates dive. There's no prepay penalty. And so you can get them to lower that rate for you sometimes in the middle of the loan. And not always, but that's a great option to have.
It's an interesting conversation. I'll be the first one to admit, but it is what it is.
All right, let's keep going.
We got to roll through these. All right, next one, commercial-backed securities loans. So these are typically made by your massive banks, your Goldman, your Barclays, your JP Morgan Chase. I'm running out of massive banks, but they're these massive loans. So they'll go make 100 million, hundreds of millions, and they'll make these tranches of loans based on credit ratings and very strict parameters. We're going to invest in these markets with these type of shopping centers, and they'll bundle up a massive amount of these loans, and then they'll sell that loan tranche on Wall Street, right? So this is a commercial-backed securities loan. It's not as complicated and difficult and timely as HUD, maybe more complicated and timely and costly than Fannie and Freddie. They're typically not doing apartment deals. They're kind of playing in the retail space when they're out there doing it.
They'll do apartment deals. It's just hard. It's depending on market conditions whether they can outperform Fannie Freddie, because Fannie Freddie is just so good.
Well, and they're selling these in the open market, right? So like Goldman, all of these companies are only going to go make this massive tranche of loans if they know these assets are being traded and they know somebody's willing to buy the bond on Wall Street, because that's literally what they're doing. They're selling this.
Yeah, these guys
to Wall Street.
got totally blown up in 08. But they're back now.
Well, and they kind of went. They were back, and then now they're kind of going away.
I apologize to all of them. I don't like these loans. I don't like them for several reasons, but I'll give you a couple real quick. Number one, we have a loan through Goldman Sachs, and we had a mortgage broker that was like, "Hey, I know Goldman. They're the gold standard. Goldman, it's in their name, man." And they're like, they don't retrade the rate. They do what they say they're going to do. And I'm like, guys, I really don't want to do CMBS. No, we got this. So we went out and got a $10 million loan. The spread was already high at the time. And they knew we were on a 1031 trade. And then at the last day of my trade, like, we're closing this loan.
So on the spread, you meant they probably gave you some market LIBOR to watch or something like that.
It was like a 230 over the 10-year treasury at the time or whatever.
Gotcha.
That's a spread. And so we get to the closing date. They don't fix the rate. Okay. The other guys, fix the rate for 320 days. Fannie Freddie fixes it before the closing date. They wait to the very end when they've got you fully pregnant. And they go out to the market and they're like, "Oh man, things are crazy. We can't get the spread, and you got to do this deal. The market, we're going to lose this. We're going to go up even more." And they changed the spread on me. They added like 20 or 30 bips, and we're talking. Put that over $10 million for 10 years. It's a huge amount of money.
I don't think people appreciate it either. It's like the day, like you've been working for months to get this deal closed. You've got hundreds of thousands of dollars in earnest money that you're going to lose if you don't close on the deal. You've spent tens of thousands of dollars. You spent all of your time that's for free, but it's got some sort of value. And then you're on the phone to verbally lock your rate the day of closing on Wall Street. And you've got a number in your head because you've got the freaking 10-year treasury pulled up in front of you. And they're like, "Yep, spread moved to 2.5. We clear to close."
Yeah.
And you're like,
it was terrible.
Yes.
And I was so mad. If I had any ability to tell them to take a hike, I definitely would. But
they knew that, which is why they did it.
Yes, why they did it. And so I hate being in a position to be taken advantage of. And so I'm not going to put myself in that position again.
Yeah. Well, let me ask you this. Criterion, the largest deal and the most money we've had to borrow is, I don't know what, maybe
like $10 million. $10
million. What if we went out and bought a $200 million retail center and we needed to borrow 150, 160, 170 million? Is that what we'd have to do? Local banks aren't going to give us that much money, right?
Yeah. CMBS loans they're going to play in that really big space if it's not multifamily.
You like that space?
Yeah. So let's not stay on it. One other thing that I don't like about them is that they're sharks.
Yeah.
And so if you get in trouble and you need to, like COVID hit, I had banks calling me, asking me what they could do to help me with the situation. CMBS didn't call, and if I called them, they'd go back and look for something I missed so they could just take the property. They do not care about you. They are going to take advantage of whatever situation that you allow them to. And so that's another reason why I don't like them. Let's move on.
All right. We're getting back in the flow.
Yeah, we are.
All right, this next one's actually kind of exciting. It's sometimes referred to as hard money, but it's private equity, right? So this is high net worth individuals. This is family offices. This is the rich guy down the road is giving you a loan for your first fix and flip. It's a guy who says, hey, you've got this rehab project. Bank maybe won't give you any additional funds. I'll loan you the 100, 500,000 or $1 million to do that rehab. And I need, 10% interest. I need it minimum guaranteed for a year. And I want a point of origination. And I want a point when you pay me off. Like that's typically what a private equity loan may look like.
Yeah. I mean, I think you're thinking of the bridge, a bridge portion of the private equity. Cause yes, if you want private equity, there's also, Fannie Freddie has a bridge program as well, but bridge loans are typically, you want it quick and easy. And, maybe the deal has some hair on it, needs some stuff. Yeah. They're going to charge you a point or two on the entry, a pretty high interest rate, and a point or two on the exit. And it's for a short period of time.
Yeah.
So that's not all of private equity, because there are certain private equity that will go alongside, let's say a bank or Fannie Freddie, and they'll just be the equity portion of the deal. And
sure.
That's a different deal. Then they're going to want an 8-pref. They're going to want, 70% of the profits, that kind of thing. So there's a little bit of a difference, but yeah.
That's the next one on our list.
What?
Yeah. Preferred equity. Isn't that more of like the,
the preferred
kind of similar, private and preferred equity?
They're very similar. Preferred equity, let's say I'm going to syndicate a deal and I've got a primary loan, and I'm going to raise 2 tranches of equity capital. One is preferred equity, and then one is investors.
Yep.
The preferred equity, they'll get a really high interest rate, like 12%, let's say.
Sure.
But they don't get any of the backside profit.
Correct.
Then the investors, they will get let's say a lower 8-pref and maybe 60-40 or 70-30 split of whatever's left. So you
lower now in exchange for higher upside.
Yeah. And so as it goes, the first lender gets paid first, preferred equity gets paid second.
Yeah.
And the investors get paid third.
So where do you see private equity in more of a long-term situation outside of a bridge loan? Let's get back to that.
Yeah. So, if we were going to go buy an apartment complex and I was going to get a Freddie loan for 75%, the private equity, I could go to a family office and I could say, hey, I got this great deal. And they'll say, awesome, we're going to write you a $10 million check.
Yep.
They may or may not require me to put equity in. Some do, some don't care as much. And that $10 million they're going to give me, which is 25% of the total, they're going to say, okay, I want an 8-pref and a 70-30 split. So that means after I get my 8-pref, I want 70% of the profits.
Oh, this is good. This is good. So this is essentially a sponsor going out, buying his own deal, essentially finding the money from a Wall Street family office or
You're
something.
You're basically syndicating it with one sophisticated investor that will dictate the terms to you.
Gotcha.
That's a syndication with like one person.
I would say that's the biggest differentiator between the two. Right.
And so essentially you're saying a syndicator wouldn't need to come up with any of their own money unless they required a little bit.
Yeah, they may say a 10% co-invest, maybe 10%, so 2.5%.
But if they don't?
If they don't, then they don't. Here's the kicker, though, with private equities. They typically want their 8% preferred return.
Yep.
Then they want 100% of the capital paid back.
Yes.
Then you do a profit split.
Correct.
So if you have a normal apartment deal as a sponsor, you're not, it may take 6-8 years or more, maybe longer, to get the 100% of their capital paid back, because you have to make in excess of 8%.
Correct.
Anything over 8% return, cash on cash return, goes to pay back the sponsor equity.
Yeah. So
not sponsor equity, but the preferred equity.
These multifamily syndicators that are, buying these massive apartment deals with private equity, right? They're living on acquisition fees, is what you're saying, because all of the money has to be returned and the upside has to be returned before they get a share of the promote. So it's a completely different structure.
It's a completely different structure. It's not a bad structure. And if you're in the long game as a sponsor, you start, you building these at year, 8, 10. Now, see, every dollar you pay down that huge mortgage, you're getting a share of. As long as you're cash flowing over that 8% and you can pay back their equity over time, eventually it's going to really pay off for you. But it just takes a while, and it's a different game than what we play.
Yeah.
Okay, let's keep going.
All right, we did private and preferred equity. Good distinction between the two. Okay, let's use one. It's called mezzanine debt. Mezzanine debt. And this is exactly what you think of. Everyone knows what a mezzanine is. It sits above the ground floor, right? So this is debt that is above and beyond a traditional mortgage, and it is unsecured in the sense that it's not secured by a real asset. And Joel brought up a good point before the show. They do typically get their security from some sort of LLC interest, right? Like if you default on this mezzanine loan, they can't go file a foreclosure on your property because there's still a primary lien holder that is going to be doing that. So they will take control of your LLC and they'll try to get that primary loan to not default is their sense of security, I guess.
So why would you need mezzanine debt?
You don't have enough money, Brian.
Well, let's say your first loan is 70% and you can't raise 30% equity, or your equity is really expensive for whatever reason. You know, you're giving away a lot of the ownership. Well, mezzanine debt seems expensive when compared to the primary loan because the primary loan may be at 5%. Mezzanine might be at 11%, and they may have a point in and a point out. So it's expensive, but it may not be as expensive as giving equity to investors.
Right. And so who is supplying this mezzanine debt?
Great question. It kind of plays in the private, preferred equity space. And it's just additional debt, right? It's not an equity. It is still a debt component. So fixed interest rate, they may have some sort of origination. They may have some sort of exit. They don't have real property collateral. They've got LLC collateral, and it's a loan.
Let's explain that a little bit. It's a lender that has the option to convert their debt into equity in the event of default. Okay. So it is a lender. They're lending you money.
Correct.
But they can convert that into equity in the business, or even just all the shares of the business in the event you default. So it's really a unique position for them to be in.
They underwrite your LLC and your operations obviously thoroughly to make sure there's no other debt, because their security is essentially kicking you out of the equation and trying to earn their capital back.
And they're going to go up to, they may be 10 or 15%. So if you have a 70% loan, they go up to 85%. Maybe if you had a 75% loan, they may go up to 90, but they're not typically going over that.
Okay. So I'm asking myself, when would I get mezzanine debt? So a circumstance where we needed additional debt was the trailing 12-month financials on a property were not amazing. They had gotten a bunch of new leases recently. So the forecasting 12 months looked amazing, but the trailing 12 months looked horrible. Therefore, the bank said, hey, we'll go to 50% LTV or 60% LTV.
Or something. Yeah.
So we had to find some sort of mezzanine debt. I think we ended up getting a second mortgage on the deal, which was a pain in the ass because you have to go involve the primary lender and get their approval for a second mortgage, and that's a whole deal. But that would have been a perfect case for mezzanine debt, right? And the only reason we ended up getting a second mortgage is because mezzanine debt is typically more expensive than a mortgage. It's still a debt instrument, but it's 8, 10, 12%. Because they know if you could get the money somewhere else, you would.
And they're in an inferior position in the event that you default. So that's why it has to be more expensive. Yeah. But once again, it can be cheaper than equity. And so that people still use it. All right, last one.
Yeah, so the last one is really kind of the culmination of all of this, right? And we'll just put it in the general bucket of crowdfunding. And crowdfunding is this unique thing to go and see this capital stack, right? And to see these 8 other options we've listed out. You've got all these different types of equity. You've got all these different types of debt, right? So now we use our imagination and say, hey, here's this $10 million property for sale. So I can layer in, a $7 million mortgage. I can put a $2 million of preferred equity or preferred debt or mezz debt, and then I can put in 10% equity. Learning how to build your capital stack in the most profitable way for you as a sponsor, for your investors, that's how these deals are done, right? Is understanding the capital stack better than the next guy. That's the difference between different sponsors underwriting. We all are looking at the same deal. Some deal will have 5, 7, 10 different bids. You'll bid against other people, right? And everyone's using different underwriting assumptions. Your ability to get creative with this capital stack and get a deal across the finish line the most profitable, secure way is really a massive key to success in commercial real estate.
I just want to add before we wrap up what's one of our longer shows is that we are definitely not experts in any of these loans. We've done several of them. We were just trying to give you a general idea. So you use Google, talk to a mortgage expert in your industry, and get the real details on all the pros and cons of all of these lending instruments so that you can be successful.
Agree.
All right, guys. Thanks. Until next time.
Thanks, guys.